Hi, this is Mary Nasi with IMT Realty. Today I am meeting with Scott Kibbe from Loan Depot, and we're going to be talking to you about the various types of loan programs available to home buyers. I think we should start with conventional loans if you want to
Okay,
start
great.
there.
Thanks, Mary. The conventional loan program, conforming if you will, is what most people probably are aware of. It is the option for most people who have a down payment, have a good credit score, and or are looking to purchase a house not as a first-time home buyer. Some of the parameters of a conventional product are 3% down. Those actually come with an income and sales price limits. But once you get to the 5% down products, there is no limits up to the conforming limits, which in Hartford and most of Connecticut has jumped up to $510,400 for the conforming limits in this area. As most people know, if you put 20% down on a conforming product, you don't have to pay mortgage insurance. Mortgage insurance is on pretty much all products except for VA if they do not have 20%
Loan to value.
or 20% down payment, 80% loan to value.
Okay.
With conventional and conforming products, the interest rate is credit score driven, unlike a lot of the first-time homebuyer products you've heard of, FHA, USDA, those sort of things. Buyers can have credit scores as low as 620.
But their interest rates will be higher.
The interest rate will be higher, correct. And in some cases, the 3% down function is really an amazing program, but again, it does come with the income limits and the sales price limits, and those actually allow for the lower credit scores.
Okay, but it's going to be higher interest
rate. Yeah.
Okay.
Yeah.
So the lower the credit score, the higher the interest rate.
Correct. With the conventional conforming products, unlike USDA, VA, and FHA, and CHEA, they do not have upfront mortgage insurance. We'll get to that in a little bit. And usually the conventional loans are the quickest to close with the least amount of fees. So usually you can close those inside of 30 days.
And the conventional loan product is probably, well, it's used by people who obviously have higher down payments, but also if you're dealing with a property that might not qualify because of certain physical characteristics, that's the product you're gonna want to use.
Correct. As we'll get into with the government programs, there's a lot of restrictions in those programs, including peeling paint, hand rolls, safety issues, really.
Yeah.
With a conventional product, it's more just as long as it's move-in ready and functional, they're not really worried as much about safety.
Right. Buyer beware.
Yeah, with the conventional products though, for the Fannie Mae side, they allow you to go up to a 40% DTI, which is debt to income. You're gonna hear a lot of acronyms when we're talking mortgagees. But debt to income ratios go to 45% of your monthly income. And then on the Freddie side, it goes to 48%. So it's nice to have that little bit of extra 3% if we want to move it over to the Freddie Mac side.
Okay, at the end of the video, we'll have stuff for you to download if you want, where you can calculate. We'll give you the formula to calculate your debt to income ratio.
Yep, exactly. Okay. Also on the conventional and conforming side is the only way, if you're not a first-time home buyer, to buy an investment property. For a single family, that's required. A single family or condo, it's required of 20% down. For a multifamily, it's 25 to 30.
Okay.
So moving on, do you have any other questions for
I don't think so.
conforming loans? Okay. So moving on to CHFA and FHA. FHA is the Federal Housing Administration program, and CHFA is the Connecticut version of that, which is the Connecticut Housing and Finance Authority. Those both offer low rates. They offer the ability to put 100% financing with the CHFA DAP, which is a down payment assistance program, which is actually two loans. It's a first loan. If it's on the conventional side, it is a 3% loan. If it is a government down payment assistance program, it's a 3.5% second loan. With those loans, unfortunately, mortgage insurance is for the life of the loan. So that's why we talk about, what's so great about FHA and CHEA is that it's not predicated on interest rate as far as, on credit score, your interest rate. So you could have a 580 credit score and you're getting the same rate as someone with a 660 credit score.
Okay.
They do have a little bit of incentives if you get up into the 700s and you're still using one of these programs where the rate might be a little bit better, but it is supposed to level the playing field across the board. With the FHA, one of the cool things about that is if you buy a multifamily, even if you do not have a history as being a landlord, you can use the income from the subject property qualify.
Oh, okay.
Which is really cool. Yeah, it's very helpful. I have a lot of clients buying multifamilies as, their very first home. Why not get into a multifamily to?
So that means like if somebody qualified for a single family at 200,000, they might qualify for multifamily at 250.
Exactly. If it's a 4-family, it might be 300.
Even more.
Yeah.
Okay.
Yep. Obviously, we only use the units that they're not occupying.
Right, to
calculate
generate
the income. Yep.
So just to clarify that's only for owner-occupied multifamilies.
Correct.
Okay.
Which is only allowed with the government programs.
Yeah.
They have to be government, or
Okay.
excuse me, they have to be owner-occupied. Back to FHA and CHEA as far as what you brought up as far as the inspections. There is a lot of attention put to health and safety issues. So no peeling paint allowed. Handrails must be in place.
Yeah.
Roofs can't really show any sign of wear. If they do, we have to have some sort of inspection, whether it's just a contractor coming out and writing a letter saying that there's 5 years left in the roof. Yep. The great thing about the FHA and CHEA is that for CHEA, it goes down to 580 credit score, which is pretty amazing.
Yeah.
FHA, we have programs that go down to 520. Now they're very hard to manipulate, and they do require from the 580 score down to the 520 a 10% down payment. But we have gotten a lot of those through. You have to have some reserves. So there are some people out there who have been through unfortunate issues in their life where it has damaged their credit, whether it's a divorce or an illness in the family that created problems with income,
financial hardships.
Financial hardships, exactly. CHFA, great program, has a lower than normal interest rate, does require a 1% of the loan amount charged that goes directly to CHFA. On top of, FHA also has a 1.75% upfront MIP charge, which is mortgage insurance. So not only are you paying a monthly mortgage insurance premium, you're also paying 1.75% upfront for the FHA loan just to use the program. Again, it's for people who don't necessarily qualify for other programs.
But those costs can be rolled into they're part of their closing costs.
100%.
And there's ways to get help with the closing costs from sellers, et cetera. Okay.
Yeah, we can cover that. 100% about that. And the reason they have these programs were designed is that they don't want to keep people from buying homes.
Right.
Yeah, you have to pay a couple extra fees, but that really is, a lot of that goes into just making the investor feel safer about the overall purchase of the loan.
And that's regardless of your credit score then. So if you're one of those people that are using the FHA product with a 680 credit score, you're still paying the same fee.
Correct.
Okay.
Yep.
All
All right, so then moving on.
One more thing, sorry. CHFA though, there are income limits, correct, with CHFA?
Sorry, yes sir, absolutely. So CHFA has income limits by county and by town.
Okay.
They also have sales price limits by county and town. A normal CHFA participant probably will not hit those limits necessarily,
Okay.
but you never know. Especially since we do have CHFA in Fairfield County, and sometimes people are making a lot of money out of that area, and unfortunately, the income limits.
Okay.
That's it for FHA. Now we also have what they call the HUD $100 down FHA program.
Yeah, this one I'm excited to know more about.
Yeah, it's an exciting program, exactly. Yeah, so it's only available for HUD REO properties, and it's only it's for full price offers. I didn't know this. I was actually doing a little research about that. HUD does not negotiate.
No, they don't typically. They'll reduce the price, but typically they have a very low threshold for fluctuating off their asking price.
Yeah, so that was one of the things that they did say. Now, obviously, your realtor can tell you better, what is acceptable, what's not. But the $100 down payment has to be included in the actual contract that you write, but then it's just literally $100 down, and we write everything else through HUD as one mortgage.
And that's for owner occupancy, correct?
Only owner occupied for all FHA loans.
Okay.
Yep.
All right, that's a great program. I didn't know about that one before.
Yeah, it's actually been around for a little while, but I mean, because it really depends on if you have a lot of HUD REO
Right.
properties in your area.
We did it one time, not as many now.
Yeah, the inventory's low right now, right? Yeah. So moving on to the rehab loans. We have a variety of rehab loans. We have them on the FHA side. Most people have heard about the 203K. It's a great program. And there's a streamline, which is $35,000 or less. It doesn't allow you to move load-bearing walls, stuff like that, but it allows you to fix those safety issues we were talking about earlier. If you have an FHA loan, or excuse me, if you have a house that really the client is only going to go FHA, but yet the home isn't qualifying for, then
Right.
it's pretty easy to stick them into these FHA streamlines. They have 6 months to complete the work. It has to be by a contractor not related to you. That's really the one caveat that most people don't like. But that again is just a fraud issue, really. They don't want people working on their own properties, and that really, that could, God forbid, something happens where they put something in wrong, and then the inspector for the town says no, and you have to rip it out. Then that could be not very cost effective, and cost delays.
Right. But you could spend that money on, so if we're showing a house that, the kitchen and the bathrooms are dated and the furnace needs to be replaced, it's aging out, you can use it for the safety issues as well as cosmetic.
100%. And we actually talk to people a lot of times, if you're going to do something revolving around a lot of properties that have been sat for a long time and have become dilapidated, sometimes there's problems with the furnace, people stealing, copper pipes and stuff like that. And if you're going to do your furnace, that's not really going to add overall value to your house. So why not contemplate, if it has a dated kitchen and or bathrooms, put something in, It's like you're going to live in your house and you're going to want to update that stuff, and how normal people, you're working along. It takes a while to save that money. So why not do that stuff in the very beginning, make the house your own, and kitchens and bathrooms are what obviously increase the value of your house.
Yeah. It definitely opens up the inventory to people, because a lot of people don't want to do the work, but when they hear about the program that it's done by a contractor, it's done right after closing, and then they get the house of their dreams. I prefer to pick out my own kitchen and have somebody else design it anyhow, so I like buying houses that need that stuff.
And you can actually roll in your mortgage payments during the construction phase.
Oh, I didn't know that.
Yeah, that's again, it's another thing where we explain it to people, but a lot of people don't necessarily want to do that because it's just adding on, obviously. But
if they're renting someplace while they're doing the construction, that helps.
If you're doing a full project, 100% that helps.
Okay.
So now, about a year and a half ago, we rolled out a conventional side renovation program. It pretty much follows all the same guidelines as the FHA product, except that it allows you to do a rehab project on a single-family condo investment property.
Oh.
And or you can do second homes.
Wow, I didn't know that.
I know, and that's pretty incredible.
And that's an FHA product or a Fannie Mae?
No, it's
Fannie Mae.
Fannie Mae, Freddie Mac.
Wow.
Yep. We're one of the few companies that has it in Connecticut. But it's a great program. Again, for the person who maybe is already established and wants to refinance into a conventional product, or if they're, again, not necessarily a first-time home buyer and want to do a renovation loan, it gives them a nice option rather than having the FHA, where, again, life of the loan, mortgage insurance, that sort of thing, plus the fees up front.
Right.
Moving on, we are the only company that I'm aware of in Connecticut that has the VA rehab loan, which is pretty exceptional, especially in this area with the sub-base and Coast Guard Academy and all that. We love this loan. We love the fact that we're giving back to the people who've done the most for our country.
And that's still 100% financing then with the VA loan.
It's incredible.
Yeah, that's great.
So with the VA loan, no mortgage insurance. It's the only government product that has no mortgage insurance. There is a 2.15% upfront VA funding fee, which takes the place of mortgage insurance. There is no monthly mortgage payment, but They do have it up front. Now, the great part about that fee is that if, God forbid, you were disabled in the line of duty, they waive that fee.
Oh, okay.
Yeah, so.
And what's the maximum amount you can
Borrow for the rehab?
for the rehab? Yeah.
On the VA side?
Yep.
So it used to be 50,000. There is no limit now.
Really?
Just changed it. Obviously, the way, and we actually haven't touched on this. So the way it works with all the rehab loans is on the big ones, not the streamlines, is that we get two appraisals. We get one up front as is, as the house you're buying, that has to equal the contract price no matter what.
Right.
And then we give to the appraiser a punch list of all the items that you're going to renovate, as well as the cost for them. And then we provide that to them. And while they're doing the first appraisal, they do a second appraisal with a value after completion of all those repairs. And as long as that comes in accurately, it can go up. On the FHA side, one of the cool caveats to that is that it allows you up to 110% of the value. All the rest of them are 102.
Okay.
So as long as it comes in with 102% of the value of completion, yeah,
That's amazing. That's a great product.
yeah, it really is, and we're very, very proud to have that. It took a while with us with the VA, kind of negotiating that.
Yeah, that was always difficult because sometimes you'd find a house for a VA buyer that had peeling paint, and they had to switch products or not purchase it.
Yeah, I mean, we'd get away with it during the winter. We could escrow during the winter if the weather conditions wouldn't allow. But other than that, yeah, you were absolutely
That's awesome.
Yeah.
Okay.
So the last loan, the government side, is the USDA loan. That's a product that we see around here a lot.
Yes.
Not so much, obviously, towards the cities because it's not allowed. But it's for rural homes only. There's a great USDA geographical site eligibility locator online.
I use that all the time.
Yeah, so you just go in, type in the property address, and it'll tell you whether or not it's eligible.
Yeah.
USDA is a little bit stricter than FHA and VA. They still are only going down to 640 right now. They're upfront. They also have upfront MIP, like FHA does. They call it the guarantee fee. That's 1%, so it is lower than FHA. And the MI is also lower than FHA.
Is their overall interest rate lower?
Interest rate is comparable.
Okay.
It used to be a little bit lower. All those rates are kind of changing now and fluctuating.
Yeah.
FHA used to be lower than conventional a lot of times, and it's not these days. But USDA is 100% financing.
Yeah, that's nice.
So with all these 100% financing, we should probably talk about true 100% financing, which is adding a seller credit and or a lender credit to roll in the closing costs and or prepaids, which are escrows. Excuse me. So with seller pay closing costs, how we work that out is the easiest way for me to explain it is we settle on a sales price of $200,000. On the conventional conforming side, you're allowed up to 3% back for closing costs. On the government side, you're allowed up to 6% back, which is they have more fees obviously, so you need more. And so you just tack that onto the top with that money coming back to the seller. So on a $200,000 loan, say it's an FHA loan, the fees are going to run probably $6,000 or $7,000. You would ask for $6,000 or $7,000 back, and so you'd have a sales price of $206,000 or $207,000, depending on what you're asking back. With the seller still netting that $200,000, but the $6,000 or $7,000 now being allowed to be rolled into the mortgage to pay for the closing costs for the seller or for the buyer.
And we just have to make sure the house will appraise.
That's really the only caveat that we see is that sometimes if the house is right there, there's a bidding war that might not work out.
Right.
Yeah.
Yeah, I think it's a great product.
Yeah, no, it definitely is. There's lots of great products designed out there. We're just trying to get people in the homes these days. Last but not least is jumbo. So again, on this area, the FHA side, they actually just lowered it for parts of Connecticut. So we're down on a single family down to $331,760 in New London and New Haven counties. It's a little bit higher at $353 for Wyndham, and a little bit higher than that for Hartford, Middlesex, and Tolland.
So you mean everything above that loan limit is considered jumbo?
Considered jumbo.
Okay.
Now, for most people now, because for about the last 15 years, FHA and conforming loan limits have been the same. This year they changed. So now the conforming is still at, or has gone up to 510. So the obviously idea would be to say, hey, if your house was like say 400,000 in New London County, you'd be like, instead of putting 3.5% down, as long as your credit score allows for that and your down payment, you'd move from a 3.5% down to a 5% down conventional and just do that.
Okay.
Now, but if you're over 500,000 or 510, 400, you're going into jumbo. Jumbo rates are actually really good, but they require massive down payments usually.
What's massive?
Usually at least 10% down, up to 20%
Right.
down. Loan Depot does have an awesome program that they developed. It only allows you to go up to 1.5 million, which is still
We can manage.
Yeah, we can manage that. Our other jumbos go up to 5 million, but so this one goes to 1.5 million. It's 95% LTV, so 5% down, and here's the great part: no MI.
Really?
Yeah, we're the only ones out there that have that as well. So again, some of these derivative loans that we have, you know, the idea is that we're going to keep them in house. We're not going to sell those in the secondary market.
Yeah.
That allows us to kind of, you know, match a need out there.
Yeah.
So, and we also have 15-year amortization schedules for jumbos, which we don't normally have in the jumbo market. It's usually 30-year terms, and they have ARMs as well based on that 30-year amortization schedule.
So you could do a 30 or 15 or just 15?
You can do a 30 or 15. The ARMs are all based on 30.
30.
And that's the same on the conforming side. We do offer ARM products for all, we haven't even on the government side, on the FHA, but for all the conforming loans, the ARM products, whether it's a 5, 7, 10, or a 3-year ARM, they're all based on a 30-year amortization.
Scott, thank you. That's a lot of information, a lot of valuable information. We'll have links at the bottom of the video that you can click on, that you can follow up with Scott on, and thank you.
Thank you so much for having me.
Thank you very much.